I was shocked to hear that Warren Buffett is also a huge options, is
Yeah,
big in
absolutely.
options as
Yeah.
well.
So at this baseline level that we're discussing, um, Warren has had a history of going in and buying entire companies using short put contracts. So people think oftentimes because they learned in B school or something that options are risky and they're, for speculation. But if you use them properly, they can be really advantageous. So Buffett was selling puts on Coca-Cola when he bought 10% of Coca-Cola. He also was selling puts on Burlington Northern Railroad when he bought the entire firm back in, I think, 2007. And it's quite remarkable if you think about what Buffett is able to accomplish. So he goes out and he sells puts and gets paid premium on, I don't know how many millions and millions and millions of these contracts he was able to write, but he's out there writing these contracts, collecting premium, and then he puts in a bid for the whole company above the strike price of all of these contracts. So he just gets paid, and then it, of course, never goes down. So he just got all this free money, and it really lowers his cost basis. So when it's available, and this isn't always available, but when the situation is available, even Buffett at this level with, allocating billions and tens of billions in a single time will attempt to use this strategy. So this is, it's fairly sophisticated. It's pretty advanced, but I know quite a few professional and retail investors that are using this in a certain way.
That's amazing.
Okay, so and I'll actually elaborate that out with one more point just to really drive it home. I figured this out in about 2005. I was working on Wall Street doing consulting for Goldman, doing risk management work, and I was dealing with all these different products within the firm, writing all these sort of helping them with model validation things, and recognize that instead of buying the stock directly, you could write these puts and just combine it. It's little algebra, and you basically end up with a lower purchase price. And over the last 17 years, this is the only way I would buy securities. It seems unfathomable to me to just buy a stock in the New York Stock Exchange because I can just turn around and I just sell a put and it could expire in a week and I still get a lower price. So so I always use this, and when it's possible, whenever it's possible, I use this. I can't fathom doing it the older traditional way. And so I encourage, the folks that can understand this to try it. Keep in mind an option is 100 shares of stock. So, don't go and overexpose yourself. But this is a very advantageous, and you learn a lot just by doing it once or twice and watching how it all plays out. Now, I think we're ready to move into a more complex application of this, something that we figured out over the last couple of years and have made enormous returns with. What I'm going to talk to you about is something that we call internally structured dividend capture. It's a super awkward name, but that is exactly what we're doing. Is we're literally ripping dividends out of the market. It is not the traditional use that I was just talking about. We're not high frequency traders, but it's a lot more transactions than we're traditionally used to. But it's so lucrative right now that, especially in this challenging market where we're dealing with inflations and we're still on tail ends of pandemics and we have wars taking place, there's a lot of risk and uncertainty in the market. It's a very challenging place. Running this engine in the background in your portfolio is just a way to completely dominate things like the S&P 500. Let me quickly share with you what are we going to be talking about? What is structured dividend capture? So basically, there are, so these contracts are priced based on the Black-Scholes model, and there's 5 Greeks. One of the main Greek that we're kind of thinking about right now is volatility. And we're in a period where there's a lot of, and it's always local vol with various companies. So we're in a period where there's a lot of volatility kind of showing up, and there's actually a volatility to volatility. So markets might not be volatile tomorrow, but next week, they're extremely volatile. And so those are what's changing option prices in a major way. There's other factors like time and things. Why don't I go ahead and start kind of sharing a screen here? Because what I'd like to do is walk you through how this came to be. I think this background is going to help your viewers understand. I'll go very quickly here. How did we come across this? All right. So we have a 4-step process for our own portfolio management. And it starts with, I've talked about this a lot in the past. So if people want to go into any other videos, they can go and look at detail. But it starts with this quarterly 13F analysis. So we're looking at, say, 100 super investor 13Fs. We're looking at all the shares that they're buying and selling. It's a big advantage. And it basically narrows down the world of investing from like 10,000 potential securities to a few hundred potential securities. Okay. So if you look at long-term value-based concentrated funds, they may have billions of dollars, but they have 7 holdings. And it becomes very interesting to see people like Bill Ackman buying and selling something, or David Einhorn or Guy Spear buying and selling something. And it's interesting. And when they're putting this huge allocation into a new opportunity, they've spent hundreds of hours, thousands of hours, maybe millions of dollars researching the opportunity. And their own conviction has allowed them to put a huge percent of their portfolio into that. So it's a really interesting thing to go and look at. So that's where we start, and we narrow down the world of investing to a few hundred securities. We then go into our fundamental analysis, which is determine what the intrinsic value is of these companies. And if we can understand why there's a big discount, why it might close, why there's great opportunity, it becomes very attractive. The next step is to apply structured value, which I just explained. So that's applying the option strategies, figuring out how we're going to buy. And I'll of course mention, when we sell a security, hopefully we don't have to sell for a very long time because that means it's just compounding and compounding. But when we do sell, we would use a covered call, which would be a short call, a sale of a call to exit. So we get paid a premium to leave, just the same way we use a short put to enter. And then position sizing is our final step. So this becomes pretty important, because what happened in March 2020 is I was doing our 13F, continuing with our 13F analysis. And as the 13Fs were being filed, I noticed that the total superset of companies had nearly doubled, which meant that all of these investors we follow were diversifying in a major way. And I also noticed that a lot of their purchases, and this is just helpful information as you're managing your own portfolio, but I noticed a lot of their purchases were going into really high dividend paying stocks. So suddenly folks were more interested in an AT&T that pays 8% dividends than maybe Amazon or Google. And whether they're right or wrong is irrelevant, but the amount of high dividend payer securities that moved into the 13F bucket was remarkable. This is an old strategy, but it made me realize that because the price had fallen and some of the dividends, payers were maintaining their payout ratios, the yields were really high. And in the past, people have tried to buy a stock right before, you get this. Dividends are different than bond yields. Like bond yields accrue, but a stock, if you hold it on the ex-dividend date and across the date of record, which is usually the next day, you could sell the stock after that and you get the dividend payout maybe a month later. So you just need to really hold the shares across a couple of days. So this isn't new information. There's been a lot of research out there and people out there who have tried to buy before a big dividend and then they sell after the dividend. And efficient market hypothesis would kind of say that the price would decline a little bit. It doesn't always quite work that way. It's an okay strategy. It's fine. One thing that's interesting, this doesn't scale. What I'm about to tell you doesn't scale to the major players. You can't put trillions of dollars in this. I don't think you can even put, you really couldn't put $1 billion in it. We run a modest sized fund, but you can easily put 10 or 20 million through this. And you can certainly put 100,000 through this. And it always reminds me, there's all this controversy around Warren Buffett when he said that he could guarantee that he could make 50% returns if he was only managing $1 million. And everyone kind of wants to know how. And the amazing way is there's a lot of ways that he would do it. And I think that this is kind of one of the types of things that he would do. He's not necessarily going to do the traditional buy and hold route. If he has $1 million, he's going to do something pretty creative and he's going to be ripping 50% returns out of the market. I'll show you here what we're talking about. Real quick step back. This is like a 13. This is how I track our 13F analysis internally. So this is just an example. This is, old data, but this is how it works. So we pull and we look at what shares are being bought, what's being sold, what's being held. We look at the superset of all the data, and it's very helpful in just guiding our fundamental analysis, as I mentioned. And this is a really good example. Sorry to just run through this presentation, but it's helped to repeat to give everyone a refresher. How do you buy a share of stock for $100? We sell this put. So in this scenario, if anybody wants to look and read through all the details, we're basically saying we're committing to buy shares for $100 over the course of a year. Somebody's paying $25 in premium for the commitment to buy that stock. And we then hold $75 of our own cash and collateral and the $25 they paid to us, which makes the $100. So we're able to buy the shares. And then there's a binomial outcome. Either the shares are below 100 and we buy the stock and it only costs us 75 because 25 was their money, or it's above 100 and the contract expires and we've made 25 on our 75, which is a 33% return in a year. Okay, so we either get the stock for 75, which is great. So when the shares appreciate to 750, we make 10x, whereas the person who paid $100 only makes 7.5x. And alternatively, we make 33%. So the binomial outcomes are both positive in the event that the shares don't go to zero, or like the first scenario I described. So here's an example once again about how put. Now, let me jump into this. We're going to go quickly now into like the 4.0 level. So now everybody understands how to sell a put. Everyone understands the strategy and that we're looking at how to capture these dividends. What I realized is that if we sold a put that expired just a day before the next ex-dividend date of one of these high dividend paying stocks, we would collect a premium for the put, then hopefully be put the shares. And if not, it's okay. We still make a good IRR, but then hopefully put the shares and then immediately receive a dividend. And then we sell a covered call immediately afterward and get paid another premium and we exit. And so we actually get 3 payments instead of just the dividend. So we make a put premium, so our costs go down, then we get paid the dividend, and then we sell the call and we pay a call premium and we exit. So what does this look like? I looked around at some of these high dividend paying stocks, and here's one for KKR. Now you'll have to bear with me because the prices are all changing, and some of this data is from 2021. But you just go and you look up the current prices and you apply it to today's current market prices. You're only holding these shares for maybe a few weeks maximum. So what happens here? This is for KKR. All right. So, and this is a relatively small dividend, to be honest. So what you can do here, and we're just using these this is not a generic example. So I'll just go through the dates without the year. You sell a put expiring November 5th with a strike price of $80 for $2.65. Okay. So you're paid $2.65. Now, just a few days later, November 11th, you take possession of the stock. The next day, you receive a small, in this case, 0.2% dividend. You then turn around and immediately sell the call, and then the call expires. And here's what it looks like. You pick up 3% on the put, you pick up 0.2% for the dividend, and you pick up 3% on the call. And in total, by the way, there's a few little rounding things here. Over 12 days, you pick up 6.8%, which is an annualized 650% gain. Okay, so 600, it's so astronomical. But the problem, of course, is that dividends are traditionally paid 4 times a year, so you can only do this 4 times a year. All right. So, but it's something to keep in mind. So if you're looking, Jeremy, and you have your favorite, equity position out there, and they pay a large dividend, you can do it. You could just do it ad hoc with right before the ex-dividend date. You could practice this, and you could watch it all play out over the course of a couple of weeks and make a very, very decent return.